webinars. Wherever you are, I thank you for attending. I've quoted in the write-up, the précis, if you will, for this webinar, a very famous quote from an old political hand, not someone whom I know personally. I do not know people in DC. I know people in New York. James Carville is a very entertaining character. He is from Louisiana. Originally, he was Bill Clinton's political director, I believe, or maybe that was Hamilton Jordan. But he was a political advisor for many years and for the Clintons, and a very funny guy in many ways. And this is a famous remark. It's usually abbreviated as, when I come back, I want to come back as the bond market. But the full quote, which I put at the beginning of this, the write-up for today, I think is more important, or at least it's more interesting. Said, I used to think that if there was reincarnation, I wanted to come back as the president or the pope or a 400 baseball hitter. For you non-Americans and non-followers of baseball, I believe George Brett in the 80s was the last person to hit 400 number of safe on bases from hits in American baseball. So it's very, very rare. But now I want to come back as the bond market. You can intimidate everybody. One of the things that a political advisor certainly is going to do, and certainly the Clinton, Bill Clinton's 2 terms in the White House, in many ways, Mr. Clinton, politically, at least in DC, was a traditional American president. His overriding concern was the economy. That certainly was mirrored in Mr. Carville's famous "It's the economy, stupid" quote when they were running, or sort of mantra when they were running for presidency the first time. And it also, and the quote gets to the frustration of political people who are trying to accomplish something, whoever they are, and of whatever party, in Washington, jobs and economic growth. Because they're not getting cooperation, perhaps, or so they seem, from the bond market. And what is the bond market? Well, it is often, let's take a step back, as I like to do. I always like to take steps back and try and get a better view. The bond market is a trading market. It takes its cues both from the Fed and from economics, the economy, but also from supply and demand. All of these things are transmuted into the rates that you pay for a 10-year Treasury or a 2-year Treasury or a 30-year Treasury. And at different times, different aspects of how pricing determines rates are in the fore in the bond market. This is the Fed funds rate, which is one of the influences. But let's take a look at the 10-year in the, oops, here we go. Oops, hang on. Oh, here we go. Here we go. No, we have full screen, and I think, unfortunately, Google did an update and they changed things. Come on, Google. Okay, this should be it. Okay, there we go. Another technical milestone mastered by yours truly. So there are many aspects to it. We look at this, this level in the Dow right here, and we look at this similar plunge in the 10-year rate. And of course, that's 2008. That's the collapse of the world financial crisis. But look at the difference in the subsequent run of the Dow and the 10-year, and it'll tell you that different things are influencing these two chief signposts and signifiers for the American economy. The 10-year went down to about 1.3, and then it shot back up. But since then, it's come down again, and for much of the time, it's been even lower. The Dow, in the long run, never looked back after that dipped around 6,500 in late 2008 or early 2009, before it turned around in March of 2009. Never looked back. Yes, there's a little bit of variety up here. Most of these are frightenings over China, also profit taking, but we've continued to ascend to very robust levels. The problem that we're seeing, the analytical problem, is the disconnect between these two items. We're eventually going to have to reconcile the view of the bond market and the view of the equity market. Today, we're going to talk about the bond market. So, of this run post-2008, you can say, and people have many times, that it is fostered, it's because of the quantitative easing, basically. The Fed's insistence that it needs to do something, and the only thing it can do is lower rates. Since you can't get any rates lower than they were officially on the Fed funds rate, time to go out and buy debt, driving rates lower. Now, you can make that argument, and the argument is that this is an emergency measure, although it's an emergency measure running on a decade now. The problem with the argument is it's ahistorical. The trend in the 10-year rate from 2006 until now fits perfectly in a 30-year trend line. It goes back to here. If you run, and I should have done that, I didn't have time. If you run a channel from here to here, it fits perfectly. So to make the argument that this is an emergency measure, given because of the emergency needs of the US economy, is to be a little disingenuous. Disingenuous is a fancy way of saying you're probably not telling the truth. Or at least you're ignoring other burning possibilities in the obviousness of this chart. What the central banks have wrought is a logical continuation of what they have been attempting to do since the Volcker days of the 1980s. They've been attempting to squelch inflation. Well, there is no question that inflation has been squelched. We can argue and discuss why, but you have an aspect of the credit markets that seems to be losing their predictive ability. Now, what do I mean by that? Let me quote what I said. The yield on the 10-year US Treasury at 2.23% on Friday is much closer to the 2.61 post-election high right here than the 1.78 close on the Friday before the vote, which is here. Is this a judgment on the US economic prospects over the next 2 years? And even if it is, how does it fit with this long-term 30-year bull market in bonds? What we're really asking is this 30-year market in bonds predictive of the U.S. economy, or is it predictive of something else? Because what you're looking at in the bond rate and the bond yields is the traditional, or at least the analysis is approached with the traditional counter-cyclical approach and interaction between the bond market, the Fed funds rate, and the U.S. economy. What we're assuming is what the Fed has always done. It's counter-cyclical. Their policy is counter-cyclical. So when the economy starts to speed up and inflation comes, the Fed raises rates, slows down the economy, puts a cap on inflation, and we start all over again. This is about the 70-year history of the post-World War II Fed. It is absolutely not the pre-war history of the Fed. Remember, the Fed's response to the Depression was to tighten credit because it was afraid of defaults, bankruptcies. Oh, it made them worse. And that, of course, is the lesson that Mr. Bernanke imbibed and wrote his thesis on and gave us quantitative easing. So when you look at this long-term chart, there are aspects of the counter-cyclical, and you can see here and back, here and back, here and back, here and back. However, the overall trend, if you are using the 10-year as an indicator of immediate and medium-term economic cycles in the United States, is the difference in time frame. The time frame for recession and a recovery is going to be 2 to 3 years. The time frame of this chart is generational. Both things can be true. You have a cycling Fed, and you have, over time, much lower rates. But as the rates progressively lower, the ability of the rate level to predict, or at least to act as an indicator for economic health, has become less and less accurate. For the entire period from the financial crisis on, the usability of interest rates as economic predictors of the health of the U.S. economy has been practically nil. The U.S. economy has been on an even keel, about 2%, a little bit more. Fed rates have gone down, they've gone up, they've gone mostly down, and so has the 10-year, and there's been no change, essentially, and no effect on the U.S. economy. If you look at the Dow, you could say, whoa, there has been a great effect. It would look in the scale of this chart that ascent, it would appear to be, from a simply technical point of view, that ascent would be unsupportable. Every time we have an ascent of this angle or steeper, this slope here, and this slope here, which is running on 10 years now, it comes a cropper at some point from here down to here, from here down to here. And where do we go from here? Well, if we do anything like we did before, if you take this, that's about half. If you take this is the whole thing. So somewhere between here and here is the next take profit level, the next stop loss level in the Dow. But there isn't any sense that the medium term and near term variety or variations in the credit market are giving you any worthwhile information. So back to James Carville's quote. But now I want to come back as a bond market. You're going to intimidate everybody. Well, in those days, 30 years ago, 25 years ago, 20 years ago, much talk in the US of bond market vigilantes. The idea that the bond market will exercise bond traders, people, men and women making trades, taking positions, running portfolios, will exercise independent judgment based on their view of the economy. That's the whole idea behind James Carville's quote and the idea of the same time frame, bond market vigilantes. Vigilantes are, in the United States at any rate, they are citizens who take the law into their own hands, so to speak, because they think that for whatever reason the law is not being enforced. The idea being that the bond market, regardless of what the Fed is saying, will act on its own ideas. One thing that we have seen, let's take a look at a shorter chart. Let's see if we can really, I hope you like my new view of New York here. I think that's Midtown looking south. It's a rather grand view. I don't know where it's taken from. It looks like it's taken from a building someplace in Midtown because I think, yes, we're north. I believe we're north. Yes, that's the New World Trade Center. That's the Empire State Building. So we're looking south. Okay. Let's look at the, oh, here we go. Okay, this is good. Let's go. Okay, 10-year window viewer. Okay. This is the 10-year yield post-election, right? The election's right here, and post-yield. Now, this is what we would expect. As the prospects for the economy brighten, and they're brightening prospects, the Dow is attempting to discount the future, as it always does. That's what it's supposed to do. That's what it does do. That with the change in administration from Barack Obama to Donald Trump, all things economic would improve. That was the essential judgment after an initial hesitation here, right here. That was the essential judgment of the equity markets. It was also the judgment of the credit markets. As we can see, this is the run-up in yield from 175 to 263, I think was the top run. 261, excuse me. Now that's what you'd expect. There we have the bond market performing its traditional role of counter-cyclical effect. Bond prices go down. This is the traditional relationship between the equities and the bond market. Equities go up, we're looking buoyant. The bond market prices on the bonds go down, yields rise. This market, the bond market, is both anticipating better economic growth and it is anticipating higher federal rates, the Fed funds rate. So that's typical. That's what you're supposed to do. But remember the prior chart with that long decline going back to the mid-'80s. when Reagan was president and Paul Volcker was chairman of the Federal Reserve. Paul Volcker is still alive. He's well into his 90s, and I think he recently got married. So there's hope for all of us, as they say. Including now in the new world, women too, with Mr. Emmanuel Macron, the new president of France, who has reversed that, as well it should be. All's equal. Anyway, so this particular chart, when you take the long-term view, we're in a different story. But here, at the closer counter-cyclical, and the long-term view that we saw still has counter-cyclical variations in it, and we're seeing some of that here. But the question is, what are we being told? The Dow has gone almost back to the level of post-election. I think it was 211 something, and we're 29 right now, right here. This is the collapse here when the New York Times published its story about James Comey. Apparently, the markets have decided that that's not particularly important, or they don't believe it. I don't know which it is. And I doubt anybody else knows either. At any rate, the levels are back up. But the bond market is not nearly as sanguine. That means positive or optimistic. And I believe the term sanguine comes from the old idea, the old medical idea of the four humors, which regulate human health, which lasted until probably the 1840s or so. What were they? Blood, bile, air, and water? No. Anyway, I can't remember exactly what all four are. I could look it up for you, but I'm not going to. So we have here, from here down to here, a pretty substantial drop in the 10-year, the most commercially important of the Treasury rates. That is not telling the same story. So we're back to the same problem that we've been seeing ever since the advent of quantitative easing, that the bond rates are predicting something other than what the equities are predicting. And the economy is frankly just bowling along, ignoring both. Because if you look at a chart of GDP and you run a 2-year moving average or a 1-year moving average, anywhere from 2009, 2010 on, it's 2, 2.1, 2.3. It varies quarter to quarter. The more you make, the longer you make the moving average, the less variation you get, but there is no trend. Equities trend in that period is profoundly higher. Bond yield trends in that period are profoundly lower. And the economy is doing nothing. Not changing, not accelerating, not approaching recession, and not doing anything. So the question that I wanted to get to is true for both equities and the bond market. Remember, there are several aspects to both all trading markets. They trade off information. They've always been used as economic predictors. Supposedly their purpose is to discount the economy. And in one case, more specifically, interest rate policy. That would be, of course, the treasuries and corporate profits, if you will, but a reflection of the economy. But since the financial collapse, 2008, almost 10 years ago, they seem to have lost their abilities as predictors. So we have their economic ramifications. But more importantly and more directly, as far as their trading levels go, is their aspect as a trading market. And yes, in the equities and in 10-year, which is why I chose 10 years, they are seriously, there's a very large component, a serious component, I don't know how large, of long-term investors. People hold stocks, value investors, and treasuries, all sorts of economic institutions, economic actors in the economy are required by various reasons, sometimes simply logic, sometimes regulation, to hold all sorts of treasuries, assets against liabilities. So there are considerable portions of both markets that have a long-term view. I'm making a difference. I'm trying to distinguish between markets that have a much more short-term view, such as currency markets, whereas the only real movement aspect of currency markets is created by speculative trading. Very few people who are long the euro right now are long the euro for 10 years, more likely 10 minutes. It's a trading market purely, and people are only after trading profits. The turnover is upwards of 90% or more based on speculative trading positions, not on trade flows, not people exchanging Chinese yuan for US dollars because of trade flows back and forth between the countries. So for these two markets, there is a long-term view which is inherent in the type of instrument, the type of trading, and the type of market and regulation for both markets. Nonetheless, and you would, if you're going to base a long-term view, a 10-year view, you can't base it on policy. It's very difficult. Who knows where the Fed is going to be in 10 years? If you took a look at the chart in 1986 on the 10-year, would you be predicting that 30 years later, the 10-year rate would have dropped to 1.35%? You would not have. There'd been no reason to. You would have been accused of linear projection, and in fact, it turned out to be true. So if you're looking to base a 10-year prediction, you have to fall back on long-term economic trends. The Fed is not an economic trend. The Fed's rate policy is not an economic trend, except in the fact that it has been relentlessly lower. So maybe it is. Maybe I should modify my view that the Fed is not, if the Fed is an economic actor, not a reactor, because the essence of countercyclical rate policy is reactive. But that long-term chart that we looked at doesn't appear to be reactive. It appears to be proactive. Or you can approach it from the same way that Paul Volcker approached it and Ronald Reagan in the 80s, that the Fed's job is to control inflation. And so the Fed's reactive policy throughout that generation is a response to lower inflation rates, lower prices. The Fed will take credit and say that it is their rate policy which drove rates down, but you can make an equally cogent argument that changing populations, changing manufacturing processes are things that are growing productivity, essentially, that are driving prices down. And it's difficult to make, to ascertain one or the other as there being the source of lower inflation, of lower rates. But one thing that is true is that both the Dow and its bond market equivalent, the 10-year, seem to have lost a good deal of their predictive power because the people involved, the market, and this is my view, the market positions, the trading activity, which determines the levels, have become increasingly divorced from economic analysis. The bond market vigilantes have gone into hibernation. And I haven't heard that term, I've seen that term in the press for some time now. Remember, the things that are driving the markets, economic analysis as a determinant of valuation in the market, both bonds and equities. But you also have the trading factor. And aside from that, you have the factor of supply and demand. So let's look at the trading factor. We've looked at the economic predictability factor. Sorry about that, I had to write something down. So let's look at the other two and see if they have become more determinants of the price levels and, of course, the yield levels that we're seeing in the markets. One of the interesting aspects of this recovery since the financial crash and other things, without attempting to determine why, is simply to take the fact of 2% growth. 2% growth with somewhere between 0 and 2% inflation, which of course means not a lot of growth. Now, GDP is real, meaning that it's corrected for inflation. But many of the other indicators in the economy are not, such as wages. I mean, not wages, but prices. Or not prices, excuse me. But some of the things you look at, such as wages, are not corrected for inflation. Therefore, if you're running a 2% increase and a 2% inflation, there are no wage increases. So you can compare the economic growth at 2% in relation to these two markets. So what does it mean? Well, it means that opportunities for the use of funds are limited. Certain sectors have grown pretty dramatically, technology, I think, and probably healthcare. But there isn't a lot of there isn't any across the board buoyant growth in the economy. And there's always that lurking suspicion that the amount of growth that you do have is supported by these very low interest rates. So when companies look to invest, it becomes quickly a question of where. But more importantly, the answer has been the markets. It's been trading operations. It's been stock buybacks. It becomes financial manipulations, essentially. If a degree of stock buybacks and massive liquidity drive the market to all-time records, well, does that mean that the profits, both booked and unbooked, sitting on your books, are not real? No, of course they're real. So the incentive is self-reinforcing, as markets tend to be, if they're moving on a trend in one direction. It not only gets people to go with the trend, it brings new people in. So the trading aspect of the markets, and this is true for equities, and this is true for bonds. Bond prices go higher. Rates go lower. And this encourages both participation justified by return. But neither one is particularly attached to the economic predictability factor. And that's back to Mr. Carville, the reason the bond market was supposed to be the 300-pound gorilla and the 1,000-pound gorilla in the room, because the bond market, more than any other market, paid attention, traded on fundamentals. That's the basis of that remark. That's what that was telling you. And the term, as I said earlier, bond market vigilantes, that they're not interested, that these people are the analytical truth sayers of the economic world. As far as the Dow is concerned, the Dow level, they would be considered the Cassandras of the economic world. Who was Cassandra? She was a Greek, back in the Greek legends and myths. I believe she was a woman who was gifted with sight, a prophet. But the curse was that no one would ever believe her. She was right, but no one believed her. As I remember, I was reading a Patrick O'Brien book about Napoleonic Wars. And he refers, one of the characters refers to a woman named Afra Ben in the third quarter of the 17th century, when the Dutch and the English fought three or four wars, naval wars. And they were a draw, but of course the English in the long run had a much more powerful state, partially because they didn't have any land competitors as the Dutch did. But at any rate, she was both a playwright and I believe a British secret agent in Holland in the 17th century. And one of the characters refers to her reports on what the Dutch and the Dutch Navy were going to do. And he said her reports were a model. She warned us that the Dutch Navy was coming to burn our ships in Chatham yards. And true, as the character says, we did nothing about it, and the ships were burnt. But as a model of an intelligence report, it was out pure. Well, we have some of the same. That was some of the same idea that the bond market had. Only people listened to the bond market because the bond market had economic effect. So the trading aspect seems to have overlain, has seduced, if you will, the credit market's ability or interest, perhaps, in making independent economic judgments. We have another issue behind that what has happened over the past 10 years is that the credit markets have attempted to make judgment, and they've been wrong, or at least nothing has happened. The huge influx of money to the economy from quantitative easing was supposed to, in a monetarist view, which is the bond market, create inflation. It didn't. We got the opposite, deflation, verging in Europe, well, disinflation, and verging in Europe to deflation. So there isn't any, and that's when the term started to die away, this characterization of the bond market, because it's been wrong. Also, you get the idea that with this kind of growth, as soon as you start, very weak growth, as soon as you start raising rates, the economy is going to swoon, the stock market's going to swoon. Well, neither one happened. So any anticipatory trading, any anticipatory pricing in the bond market was belied. In addition, the bonds in that case, if the bond market saw that you were going to get as soon as rates went up, meaning the Fed started raising rates, then you would get a collapse in both the economy and the Dow as a predictor. Then bond rates should go down as well, and prices should go up. So the easy and standard and historical connection between what economic analysis has traditionally told and the current state of affairs post financial crash hasn't worked. So the trading aspects have become dominant. Basically, get on the bandwagon and stay on the bandwagon until you actually see a broken wheel or enemies on the horizon. Ooh, I'm mixing metaphors here, because I was thinking of an American musical, Paint Your Wagon. So the economic grounding of the bond market seems to have been worn away by the policies and actualities of the past decade. The last issue for the bond market is supply and demand. It appears, when you view from the outside, that the bond market is some sort of immutable, inscrutable entity that exists by itself. But in fact, because it's reported as yields, but in fact, what happens is you get bond prices going up and down. Well, that's determined not only by things we've been discussing, economic trends and the need for trading profits, but also by supply and demand. The bonds are not like oil. If you want to speculate in oil, all you need to do is get an account or currencies, is get an account established someplace that permits you to trade and trade. So the volume in the currency markets can expand, or the commodity markets, some of them anyway, can expand to an essentially unlimited degree. Now, there are some aspects of that. Well, let's start again. In the bond market, by and large, that's not true. In the equities market, by and large, that's true. Now, there is, of course, a very serious caveat to that, and that is you can participate in ETFs and all of the index, all of the funds that go with it. So yes, you can expand the participation in the market, but you can't buy a treasury, or let's put it this way, a much greater percentage of, and I believe the percentage still dominates, of both markets require the purchase of an actual entity, meaning a financial instrument, stock or bond. If you want to buy Apple, one of your choices, and one most people take, is to buy Apple stock. Well, if there are many more people buying Apple stock than stock is available and they're not issuing anymore, what happens? Of course, the price goes up. You have the same issue with the bond market. Normally, our profligate federal government, yes, that is a judgment, is perfectly willing to supply as much credit instruments as the market will buy. But ever since the advent of quantitative easing, private buyers now have a huge competitor. And this is what quantitative easing is designed to do. And the Fed's out there buying everything you can get a hold of practically. In Japan, they are buying everything. Literally. The Bank of Japan was for a while, and I'm not sure it still are, buying every single piece of paper that the Treasury Department in Japan issued. Well, if you're still required to own bonds because you're an insurance company or because of the distribution of your portfolio or for whatever reason, then you have to compete with the Fed for buying bonds. Now, the Fed has a great advantage. The Fed can print as much money as it wants, put as many things on its balance sheet as it wants, and you can't. And so the supply and demand functions and has functioned ever since quantitative easing to further heighten prices in both markets. Now, you can say the Fed is not buying in the equities. It's not. That's true. But guess what? Japan is buying in their equity markets. And we run our portfolios in a global market. And so however many particular buyers might be squeezed out of Japanese equities for whatever reason, perhaps there's nothing left to buy. That's not quite true. But as far as prices go, it may be. There's going to be some spillover in global markets around the world, not just the Japanese, but it'll have its effect everywhere. So the two aspects of the bond market that gave it its ostensible power to Mr. Carville have been undermined seriously by the practices and the market action of the post-financial crash world. So those two items have then turned around and taken from the bond market vigilantes their independent judgment. In other words, it seems that the bond market vigilantes have finally gotten religion. That after 10 years, and it didn't last 10 years, but certainly the first 5 years after the financial crash, there was still a great deal of talk that, yeah, the Fed can do, the Fed can do all this stuff, but sooner or later, the realities of the bond market will reassert themselves, and the Fed will be powerless to do anything about it. The government will be powerless to do anything about it, because the internal analysis and truth of the bond markets when it comes to their analysis of the U.S. economy are immutable. They're not affected by such transitory trivialities as Fed policy and political suitability or insuitability and political desires as far as politicians and what they want the economy to do. That was the view. It seems to have disappeared. If I ran a search on bond market vigilantes as a term, and I ran at any point up to, say, 2005 or 2000, let's make it 2008, cutoff, January 2009. No, January 2008. And post. My guess is you would have a declining chart that looks very much like the chart I showed you on the first page with, the first chart I showed you with the declining bond rates over 30 years. Once you undermine this aspect, the economic truthiness, great word, truthiness of the bond market, can you get it back? Let's take a look at one more chart here. This is the Dow and the Fed funds rate. Okay, this is Dow and the Fed funds rate. The chart looks remarkably like the other one, doesn't it? With the 10-year rate, with the declining slope, with the slope from left to right, declining for the rates and increasing for the equities as the supposed picture of the economy. One thing it seems inescapable to conclude is that in enjoying its 30-year rally, which the bond market, it's a generational rally in the bond markets. For 30 years, interest rates have been going down. For 30 years, bond market prices have been going up. It's always easier to be long than short in any market. So everybody's happy. But very little is given where nothing is taken away. And what the bond market has lost is its ability to predict the economy. Nothing that the rates show, and this is Fed funds, of course, in this period here, with this chart, where's my, that's the equities, sorry. It's all right. Okay. Nothing that this chart shows predicts anything about the U.S. economy. This is a political chart based on what anyone thinks. And wait, let me vary on that right here. Hold on. Where'd that chart go? Sorry. Excuse me one moment. Okay, this chart, sorry. Sorry about that. Sometimes I inadequately. Nothing about this chart, except, nothing about the long-term trend in this chart is predictive of economic reality. That's a problem. Because if the bonds, which are the basis of the most important price in the economy, which is money, if the bonds lose their ability, the bond market, or has some seriously diminished ability to predict the economy, what do they predict? And how do business actors make the kinds of economic decisions successfully that promote economic growth? Now, you don't want to be too pessimistic on this whole general topic, because if you take a look at, just take a look at Tesla, take a look at Apple, take a look at the technology companies that have grown tremendously. Look at Amazon. Look at eBay of a slightly earlier period. All of these technologies, all of these businesses enabled or enabling the internet and the web and all the related businesses have been phenomenally successful, or our own company here in FX Solutions prior have been phenomenally successful despite the inability of traditional economic indicators to predict the future. So the economy does go on, but these are isolated sectors. The general economy, even if Amazon over the past 10 years has grown at some phenomenal rate, the economy itself has not. Those sectors are not the entire economy. The overall economy is subject to minimal growth. And it is there, I feel, that the co-opting of the bond market by essentially politics economic politics, political economy, is one of the problems with growth. I've long held this view. You've heard, and this is where we're leading to, if economic actors, if you're down here and you're doing something to create a business, you have to assume, and the business needs to run 20 years, you've got to assume that not only are you going to have to deal with this variation, which is a normal business cycle variation, which has been going on for 3 generations or more, so you don't have to, it's part of the world, but you have to worry about this trend, this, and is it going to go like that? It's going to go back up. So the advent of these extremely low economic rates have both drained the bond market of its predictive ability and taken away something that businesses depend on. That is where interest rates are going to be in 10 years. Not within a percentage, but a general idea so that they can plan their businesses. And this is something that the loss of the power of the bond market, the eclipse of the bond market vigilantes, has economic costs. I've long thought that one of the problems with the economic growth post-financial crash has been the inability of businesses to form a coherent picture of the economic world in which they're operating in and its immediate and near-term future. Without at least some ability, even just educated guesses about that, it becomes difficult to plan, and it becomes essentially an inhibitory factor. So the eclipse of the bond market as a indicator is one of the signposts of the new economic world we have already entered, although likely it won't be noted for some years yet as analysis catches up with reality, as it always does. Okay, everyone, thank you very much for attending. I hope my debt to James Carville and his quotes and his views. I thank you all for attending. I hope this has been useful, and we will do it again next week. And join us on Wednesday for our weekly market directions interviews at 10 o'clock Eastern Daylight Time. Thank you all very much for attending. Everyone have a great day.